Great. Well, it looks like there's lots of people filing in, so let's get this started. So again, thank you for your time. We're just going to put together a bit of an update around mortgage, property, and tax related to property issues to consider. Obviously, we're heading into spring. There's a lot going on. There's a lot to update in the property and the mortgage market. So let's get stuck into it. So a little bit of disclaimer. You've probably seen these before. Obviously, everything we talk about tonight is general in nature. So if you do need specific advice, please reach out to ourselves, a tax accountant, credit advisor or financial advisor, or just reach out if you do have any general questions and we can take them offline. And that's just another disclaimer regarding the Atlas Wealth Management in the DIFC over in Dubai, just their regulations that we need to disclaim. Okay, a little bit about Atlas Wealth Group. If you haven't heard of us, we've got 3 divisions. We've got the financial advice or the wealth management, the tax team headed up by Ben Turner on the call, and the mortgage division managed by myself and my team. We're regulated through different governing bodies in Australia and overseas. We've got clients across 50 different countries, and I think we've just ticked over half a billion in assets under management, and a good portion of our team, or all of our team, is degree qualified and spend a lot of time training in our specific knowledge areas. So the agenda for today, I'll kick things off, give a bit of an update around the lending environment, some structuring options on the loan side for expats, some of the challenges and strategies that I see and opportunities for expats out there. And then we'll just talk a little bit about the property market in general, what's been happening over the last 12 months, looking at the city and regional performance, because there is a big differentiation between the two markets. And then what's driving some of these property movements in these different markets. The first home loan guarantee changes that are coming in this week. I'll give an update around that. And then Ben will bring it home with some tax considerations for expats. And finally, we'll have a bit of a Q&A session. So again, as Ben mentioned, please put those questions in the Q&A or hold on to them to the end. We'll get to those. So the current lending environment. So if we look at hot off the press, only a couple of hours ago, the RBA had their September meeting today. So they've held the cash rate at 3.6%. And really, not a lot to break down from the meeting just yet. We'll get that agenda information later in the month. But what the key takeaways that I saw was the board was unanimous in that decision to hold today, and they were quite jittery about the month-to-month data that came out for the most recent inflation on the monthly read. So I think it's really a wait and see. We're going to have the September quarter inflation numbers coming out the end of October, which will just be in time for the 4th of November meeting. So really just a watch and see. The other thing that really took my attention was they did make a mention around that there was quite a demand for credit in the market, and that they were seeing that the housing market has started to strengthen over the last 6 months because we had those 3 rate cuts come through this year. So haven't really heard the RBA mention a lot about the property market historically, so I thought that was quite interesting. So it'll be interesting to see what comes out of their papers in the next couple of weeks. So lending appetite for you guys, the expats, that's definitely improved over the last 12 months. As the cash rates come down, lending has opened up slightly, but more importantly, we've seen a few more banks come into this space. So there's a bit more of an appetite to lend expats. I think coming off the back of COVID, some of those banks really tightened up on their credit policy. And then where rates sitting, so cash variable rates for an owner-occ sort of now sitting around that low 5 to 5.5%. Variable rates for investors, which a lot of expats are in the market, sort of that high, mid to high 5%. And then now we're seeing fixed rates back starting with a 4. So some borrowers now, particularly with the RBA holding today, and some of the economists are saying there may not be a rate cut this year. They're pricing in next year. I know NAB's come out and changed their forecast, so we may see some borrowers opting to fix some of those mortgages if they're starting with a 4. Across the page, so as an expat, what are some of the options to think about? So obviously fixed and variable rates, there's pros and cons with both. A lot of expats are not aware, you can actually split your loan. So if you want to take that flexibility between having an offset account versus that certainty of your monthly repayment on your mortgage, that is an option. There's a lot of flexibility around that. And not just if you fix a loan now, what does that look like for the entirety of the loan? You can obviously take a loan and have it variable now, fix it into the future, have it fixed now. Once it rolls off, keep it variable. So there's a lot of flexibility around that. Interest-only loans are available for expats. Some lenders will actually restrict that, so they'll only allow P&I repayments on the loan, but there are the options around interest-only, particularly if you're trying to hold on to your cash flow flexibility. Maybe you're trying to invest into other assets, or you've maybe got a property and a mortgage overseas that you want to pay down. So that's an option. Accessing equities, obviously with the strength of the property market in Australia, I think this is really something, a key takeaway is you can access the equity as an expat. If your property's done well over the last couple of years, or if you've got one or two, looking at what is a current market valuation, and quite often we'll go and get 3 or 4 different valuations to get different data points and work out how much of that can we take out from an equity point of view. I think expats are quite often surprised, particularly if you've got a really nice blue chip property, say in Sydney or particularly Brisbane, had that for a couple of years. There's a lot of equity there that we can release to then turn that into a future investment. Construction lending is available. This is something that's really in huge demand. So anything from structural renovations, building granny flats is really, really popular at the moment to try and bump up that yield. Duplex constructions, or even trying to build something a bit of a larger project, maybe 3 or 4 properties on one title, that is also available to expats. So if you've got some land sitting there that you want to try and utilize that or put it to better purpose, it's definitely available. And commercial lending. So again, some expats with a more established residential property portfolio are looking for commercial lending. There's options available there. Across the page. So what are some of the challenges for expats? I think that the biggest challenge I see is probably that second point. A lot of expats will come to me, we'll do a borrowing capacity. They're on great income, but it's really just that lifestyle creep. So things like your rent, where you're living, that's going to have a huge impact on how much we can borrow on the Australian side. So, every time there's a couple of $1,000 increase in your rent, that's reducing your borrowing capacity by $200,000 to $300,000. So the longer you can delay that upgrade in your lifestyle, the more that's going to put you towards achieving those financial goals. Even things like having a credit card. So quite often you'll get offered a credit card with a huge limit. So a $50,000 Australian credit card limit is going to take away about $250,000 in borrowing capacity. So the longer you can delay that, put off some of those family trips, maybe instead of having 2 or 3 trips to Europe every year, maybe space it out to 1 or 1 every 2 years. Those type of decisions are going to make a huge impact on getting to that next loan, not necessarily bumping up your income, it's the outgoings. And then the other option is for the expats out there that are working for themselves. There's been a few more lenders that have opened up around self-employed income and using that income to help take on future borrowings in Australia, which hasn't been the case historically. So next, across the page. So what are some of the trends that we've seen in the property market? So if we go across the page, the market growth across Australia, 1.8% quarterly growth. This is up to the September period, and then 4.1% annually. So it has recovered. I think a lot of that's just the back of the RBA cutting the central rate. You're starting to see a bit more confidence come into that market. But if we break that down, there has been a difference in the performance between regional and capital. Regional markets have outperformed some of the capital markets at 6% annual growth versus 3.6%. And I think that a lot of that's coming down to there has still been that shift of people moving regionally. There's still value there in some of those regional areas. If you look at, say, regional areas in Victoria, you can get yourself quite a large property for $500,000-$600,000. When you compare that to, a market within Sydney, there's a huge difference in the price range. So you get a little bit more value there. It allows people to get in, particularly if they're a sort of a younger investor that's not as mature and they don't have such a high deposit. It gives them a bit more accessibility in terms of getting to that transaction. And then sales and supply dynamics. So sale volumes have increased by about 2%, but listings have dropped off about 13%. So tight supply, I would anticipate that the listings will start to increase as we head into September and the spring period. So people have a bit more confidence to list their property. When the market is a little bit slower, people are always a little bit hesitant to list it. But the other thing is that's reflecting there's a lot more transactions where people are not necessarily listing them through the traditional channels. They may be looking to transact offline or off market sales. So that takes away some of that demand around listing it through the more traditional channels. And then on the macroeconomic influences, the cash rate's been held at 3.6%. That has started to impact borrowing costs and affordability. And if we look at some of the markets between the capital and regionals, so Brisbane's led the growth, 7.9% increase, quick sales turnaround, just helping clients buy up north. If you went back 12, 24 months, quite often you could have 21-day finance clause in a Brisbane purchase. It's now turning to a bit of a Sydney market where agents are making people exchange unconditionally, sort of under auction conditions. So there's been a huge turnaround in terms of how quickly stock is moving. And then Perth and Brisbane are following with strong values and rental growth just because those tighter yields. Sydney's definitely picked up over the last sort of quarter and a bit. And then Melbourne's starting to show some growth, but they're still well back from their peak, which was just back early on around that COVID peak coming out from there. And then on the regional side, Western Australia, Queensland and South Australian regional markets have seen strong annual growth and high rental yields. And then over to market drivers. So what are some of the drivers we're seeing? Interest rates easing, that's definitely helping with, well, number one, with people allowing to access more credit. So as that central rate cash comes down, it's reducing people's assessment rate for that new loan, and that allows people to borrow more. So obviously that's going to be fed into the ability to access credit and the ability to purchase at a higher price. So that's definitely having impact. Construction activity is well below targets. I think there was a report through a Freedom of Information recently where one of the housing funds that's been set up hasn't even built hasn't even finished a construction on one of their houses. So all our targets were behind that, and that's just due to shortages in construction actual labour to get through to it, and a lot of this is caught up in red tape between council, state and federal levels. I don't see that really changing in the short term. There's a lot of bureaucracy we've got to work through. So we're going to have this chronic supply shortage on the housing side. And then if we overlay that with the continued population growth through internal and overseas migration, we're going to have this chronic shortfall in terms of having enough houses to complete the demand that's out there. And then finally, construction costs are still an issue. We have seen some of the material costs that's coming from overseas moderate a little bit. Obviously that skyrocketed on the back of COVID, but there's still really high wage input costs that go into the construction. And as I was saying earlier, a lot of those red tape costs are really feeding into the overall cost, and the taxes that are cost to bring these new properties to light. So those sort of challenges will still continue to drive the market. There's still a premium for people to purchase complete dwellings. So anyone that is listing a property or has a property that is in a complete and move-in turnkey solution, you're still going to get a really high premium for that type of property. And then finally, the first home loan deposit scheme. So the changes coming through around this program that's coming in 1 October, so this week. The big changes that are coming through is the removal of the income testing. So previously, people, if you're a single borrower, it was 120 taxable income. If you're a couple, it was $200,000. And if you're above that, you're excluded from this program. Those caps have been removed. The price caps have been increased significantly. So let's take New South Wales as an example. Previously is $900,000, it's gone up to 1.5 mil. So what does that mean? It means that there's going to be a huge new borrowing or borrowing pool that we can tap into this week, which I don't think people quite understand what that's going to do to that market, that segment. So if we're in Sydney and we're looking at an apartment that's 1.1 mil, you're now going to have this new borrowing cohort that can access this funding, a 5% deposit, so 5% of that purchase price. And the only real restriction is getting an additional 5%. So if they went from a 1.1 to a $1.3 million purchase, they just have to come up with that additional 5% for the difference, because they're now reducing or removing that income testing. And so that means that people that were essentially locked out from this program because they earned too much are now going to have the ability to participate into it. So if you're trying to buy into that price range, you're going to have a lot more competition. If you think about what that's going to do to the property prices, it's going to have a huge demand on that, demand on the property price. So we're going to see exponential property growth, I think, in those markets. So just keep an eye out for where you're looking to buy, or if you have a property in that market, what that's going to do. Treasury did some forecasting. They forecasted, excuse me, a 0.5% growth over the next 6 years, which I think is the term. I think that term's called gaslighting. Everyone knows that's not going to be the case. A lot of the experts are now anticipating anywhere between a 10 and 15% property price increase in those markets. And I tend to agree. You can see first home buyers will always come to you and ask, what is the maximum I can borrow? So if we can get people into this program, it allows them to borrow a lot more to get into a higher purchase price. It'll work out for some people, but actually what will happen is it's going to create a two-tier borrower system. So households that are a bit more established, that have a higher taxable income, are going to benefit from this program. Those with a lower taxable income that perhaps were able to access the program before these changes will now find that it's just too hard for them. It's going to be a very crowded space for them. So I think there's going to be some significant issues that will come on the back of this in terms of the pricing, but it's something for our children to work through, not for this generation. Okay, and then over to Ben for tax considerations.
Thanks, Jeremy. You can hear me okay, I'm assuming? Excellent. Okay, so we're going to deal with a couple of things today. The first thing we'll look at is how your tax residency can impact you as an Australian property owner, and specifically looking into things like capital gains tax implications for non-residents. I look at the land tax surcharges and exemptions that apply. They are all different depending on the particular state that you're subject to. So it's good to sort of have a look at that from an overall perspective. Then have a look at some structuring options for tax efficiencies, and through that we might see that it's not a one-size-fits-all sort of environment. You do need to consider all of those in particular context to your personal circumstances. Then there's a few tips that I want to share for those who are looking to sell a property whilst they're an expat, or a former expat or a future expat. So firstly, here's a bit of a summary as to some tax implications for Australian property owners, depending on whether you're a resident or a non-resident. And the first thing to look at is, as Australian taxable property, the rental income and expenses will always be taxable to you, regardless of whether you're a resident or non-resident. So that means you always included your rental income, and you include your expenses that are associated with that. So really no difference in the application of the rental property schedule for a resident versus a non-resident. The difference, though, can translate in how other income may be taxed in that tax return. So quite often what we'll see is that you've got a negatively geared property. If you're a tax resident, that then is directly offsetting employment income, for instance. And so that's giving you a direct benefit for the tax negative amount that you've got in your tax return. Whereas if you're a non-resident, you may not have any other taxable income that needs to be picked up. So that will often generate a loss in your particular tax return. That loss, yes, it's rolled forward year on year, so you can use it up when things change and it becomes positively geared. And if it does swing to positive, then you are then taxed at non-resident marginal rates, which start at 30% up to 135,000. So that's roughly how it translates differently from residents and non-residents. The capital gains tax discount applies on a basis considering how much of the time you were a resident versus a non-resident over the whole time you own the property. So I'll go through some examples on this just to show you what that means in practice. It's different to the main residence exemption, which is a simple on-off switch based on whether or not you're resident at the time of the sale. Do not confuse that with the CGT discount. So regardless of what the position is under the main residence exemption, if you're taxable on a particular portion of that property sale and there was a period of tax residency over the ownership period, then you are still eligible for a percentage of that CGT discount. And I'll run through what that looks like in a second. The main residence exemption, as I mentioned, there was a change brought in 2019 where they effectively removed that exemption for people who are non-residents. And the critical time there is the signing of the contract, and I'll go through that in more detail in a minute as well. One thing I mentioned there is that losses do need to be used up in the first available opportunity. So sometimes you're in a situation where you're generating lots of losses in your tax returns, and then you come back to Australia and you're in a position to use those losses up. You just kind of want to see how that may look, because if you don't want to be using up those losses up against the tax-free threshold portions, because they're then going to be inefficiently used compared to that potentially offsetting at higher marginal rates. So here's an example about CGT discount, just to sort of highlight what I was saying about before. So look, let's consider a scenario where you bought a property back in 1st July 2015. You've then moved overseas and become a non-resident 3 years later on 30th of June 2018. So that's 195 days of when you lived in that property and that you were tax resident. Now, you may not have lived in the property. This situation still applies regardless of that sort of scenario. So if we're talking about just properties that you rented out, then this can still apply to you. But let's just say you've been overseas for a total of 4 years as a non-resident, then that's 1,462 days as the non-resident portion. And then you come back to Australia and choose to sell the property 3 years later, then you've got another period of 1,095 days as a resident. So when we're looking at the resident days, we're adding those two green sections together. So the two of those are 2,190 days, and the total ownership period across the time from when you bought it to when you sold it was 3,652 days. So the way you work out the discount is the 50% discount applies to the 2190 divided by the 3652. And so that's, in this scenario, 30%. So what we're saying here is 60% of the time you were a resident, and you get a 50% discount on that 60%, which translates to 30% in this particular scenario. So this is something a lot of people misunderstand exactly how it works, but the maths in this is not too difficult. There are some nuances with that, especially for properties that were purchased pre-2012, because there was a market valuation rule you could do in that circumstance. So if that's the case, then there's some additional options to perhaps get a better result. So now looking at main residence exemption, and these examples that I want to show you are looking at some of the extreme examples, and I'll show you a more normal example as well. But this first one here looks at a situation where someone has lived in a property and owned this property since 2008. So a long time ago, they've held this property and lived in it the whole time that they've owned it, and then move overseas, put it on the market as soon as they go overseas, but it takes 3 months to sell. They've signed the contract though, whilst they're non-resident. So let's just consider this with some numbers. You've bought the property for 500,000, you're selling it for 1.5 million, and that's on paper gain of $1 million. They critically though sold whilst non-resident, which means that the main residence exemption under normal circumstances, assuming the life events test don't apply, means that the whole $1 million becomes taxable to you. Now, when we do calculations like this, yes, there are adjustments that we make, and there's things we can add back, like the ownership cost during this green period on the screen. like mortgage interest and those sorts of things. So there's definitely things we can do to improve the position. But the basic scenario is that you've got this strange outcome where potentially that full $1 million is up for Australian tax. And this sort of highlights the sort of unfairness of the particular rules, because here you've got a situation where someone has owned the property for the same amount of time. They lived in it for 6 months before they started renting it out. Now, this could be whether they've rented it out regardless of whether they've gone overseas or not, but normally it does coincide with them going overseas. So here they get the full 6 years that they can treat this as their main residence, which is this period up to 2014. Between 2009 and 2014, that's still treated as their main residence. Now, there are some caveats to that. You can't have another main residence some other place or anything like that. But most people that I would speak to would normally just have the family home who then rent that out once they sort of leave. So they come back just as soon as the 6 years is expiring and then live in it for another 6 months. They're a resident during that time. What happens is they reset that 6-year counter. And so here we've got another period of 6 years between 2015 and 2020, where that is completely exempt as well, able to be treated as the main residence exemption 6-year period. They then move in again just before the 6 years comes up. And again, they get another period of 6 years that they can treat as exempt. Now, they haven't used the full amount up, but say they've come back, and this is a scenario where they don't have to have moved back into the property to reactivate that. But the critical thing is that they are a tax resident by the time that they sell the property. Now, that is the day you land on Australian soil and you make the intention to treat Australia as your home. It's obviously a little bit more to it than that, but if that is your scenario and you are likely to be treated as a tax resident from then, you sign the contract. And under this scenario, even though cumulatively you've lived in the property perhaps 18 months, this would be eligible for 100% main residence exemption. So there's no taxable amount in this particular scenario. So obviously these are a bit extreme, but there's some circumstances where I've seen that so closely aligned to this, and does highlight that the contextual consideration of fairness doesn't necessarily come into these particular rules. In a more normal scenario is we get a situation where someone's lived in a property for a couple of years before they've gone overseas. They've then rented out a property, and in this case, they're renting out for 9 years continuously. So that's these two periods here of the yellow plus the red, which are going to say it's still the same $1 million gain. And they've come back to Australia in 2020 and lived in the property or not rented out during that time. So the assumption is that they're living in the property for the last 6 years. Then the green period is exempt. The other green period is exempt down the bottom, and this yellow period is treated as the main residence stays under the 6 years rule as well. It's just once you've hit the 6 years in 2017, that 3-year period is then particularly taxable. So in this scenario, they've owned the property for 17 and a half years. Now, 9 years whilst they rented it out. The first 6 years, as I mentioned, is treated as main residence. Only those last 3, that's not eligible. So the way we calculate the exemption here is the first 2 years is exempt, the last 6.5 years is exempt, and that 6 years under the absence rule is also exempt. So that's a total exemption of 82.86%. So in this scenario where you've got $1 million gain, you're only looking at about 17 or 18% that's taxable. That's further reduced by the available CGT discount, further reduced by any cost-based adjustments you can have during your ownership period. So you probably get a pretty good outcome in this particular scenario. So there's some myths here that I deal with all the time that a lot of people misunderstand. So it'd be good to sort of set the record straight on some of these things. A lot of people think that you get a market revaluation on when you became a non-resident. So if you had all your growth that occurred before you left, and then you hadn't had much growth after you left, then you're only taxed on the growth after you left because you get a market revaluation when you leave. Now, that is not the way that the section works. The section only applies first and foremost if you have the main residence exemption apply to that. Now, if you're a non-resident when you sell the property, the main residence exemption, including the entirety of this, including this market revaluation section, does not apply to you. So that's a big misconception. A lot of people then are put out by that. So just bear that in mind. Some people also think that the CGT discount also is zero if you sell the property whilst non-resident. And hopefully that example that I showed you there can evidence that no, if you've got fractions of the time where you own the property that you are a resident, then that's apportioned on that particular basis. Some people think that they don't need to do a tax return if you're a non-resident. Even if your property is negatively geared, the requirement is clear that you need to lodge a tax return and put that income into the tax return and the expenses associated with that to recognise any particular losses. A lot of conveyancers have a bit of a checklist on how they go about the conveyancing process, and invariably 99.9% of their clients that they deal with need a clearance certificate to be able to alleviate the foreign resident capital gains withholding on that particular sale. But the whole purpose of the foreign resident capital gains withholding is to put aside 15% tax for the provision of tax for those people who sell whilst non-resident. So by definition, if you are a non-resident, a clearance certificate is not applicable to you. So if you ever have a conveyancer say to you, you need a clearance certificate and you are a non-resident, I encourage you to reach out to us. We'll set the record straight and tell you what you can do. But the mechanism for doing an adjustment to the withholding is through a variation process, which is something that you do if you run the numbers and work out that your actual tax that's due is going to be less than the 15%, then it's worthwhile doing a variation and submitting that to the tax office so that then they don't have more than what's going to be required when you do your tax return sitting inside the tax office's purse for that particular period of time. Some people think that you need to move back into your property to reactivate your main residence exemption. It's not a strict requirement, but if you do that, then you may reactivate and refresh the 6-year absence rule. So it can be helpful in some circumstances, but by application of the rule, you just need to be back in Australia as a tax resident to reactivate the main residence exemption for the fractional percentage that is available to you. So that's relevant to a lot of people I speak to, because a lot of people find that when they've rented out their home for many years, they're then coming back to Australia looking to upgrade, and they may even find a job in another city so that they then may never look to live into that particular property. You still get the main residence exemption applicable to that without having to uproot your life and live in that property necessarily. So another thing that's quite topical with a lot of people is land tax surcharges and exemptions. So what's key to understand about land tax and stamp duty is that it's a state-based legislation. So every state and territory is different on how they apply this. I've got a table in the next slide, which is quite busy, but it will sort of highlight some of that. But there's some key differences that you want to be aware of. The land tax threshold will be different in each state. Some states have a particular reference to foreign persons or absentees, as they call it in certain states. And there'll be an additional land tax or additional stamp duty if you are a foreign person. But unhelpfully, the definition of foreign person is different in each state. So you do need to understand that, and you'll often see a lot of people on Facebook groups and whatever who are debating what a foreign person is. You do need to understand that whilst they may be right for one transaction, if they're applying to a different state, it could be completely irrelevant. So you do need to really understand that particular rules in each state. Sometimes the foreigner surcharges actually apply regardless of the land tax threshold. So you might have a situation where your land value is below the normal land tax threshold, but if you're a foreign person, you are caught anyway. And that is something that is quite a big issue, because some of the foreigner surcharges are actually quite significant. New South Wales, for instance, is like 5% of the land value, regardless of whether you hit the threshold or not. So look, we are going to as I understand, send these slides out. So don't be too concerned if you don't see all this data. This will be just for your as a bit of a reference. But a couple of key things to point out is that each state and territory has different land tax thresholds, ranging from 0 in ACT up to 1.075 million in New South Wales. But what's consistent is this is all on land values, not the improved or the property values. So like typically units and things like that will have a lower land value, whereas blocks of land will be higher. They changed the rules a while ago, and pretty much all states are now aligned that they aggregate properties. So if you buy more than one, then they add all those land values together. It used to be the case that, Queensland, for instance, you could buy multiple properties, and if each of them were under the threshold, then you'd be okay. But that's not the case anymore. The principal place of residence exemption, which is not to be confused with the main residence exemption for income tax, looks at whether or not you're liable for land tax. A lot of people seem to confuse the two and think, oh, it was my former place I lived in, I won't ever be subject to land tax. The rule of thumb is if you're renting the property out, then it will be liable for land tax. The question is, when will that be the case? A lot of these trigger points are in different times of the year. Some is at 31st December, some are at the year prior, some are quarterly, and they look at whether or not you're living in a particular date. So you do need to be aware of that. And so sometimes there might be a bit of a lag between when you need to pay first land tax bill. It does catch people out, and the tax office is definitely auditing uh, this data. They're sharing tax return information where you've got a rental schedule with that property clearly listed as being rented out and how many weeks it's been rented out in the year. That information is getting to the state revenue offices and providing them all the information they need to raise an audit on your land tax assessments. And we've had lots of people come to us who have received these notices and saying, what's going on? No one told me about it. And we've been able to determine that that's an issue that has arisen through that particular process, and then we've been able to resolve that. So it's a conversation we have with any new clients that we bring on board, that they are aware of the obligation. If you've rented out a former main residence, that you flag with that revenue office that you are renting it out and you are going to be subject to potentially land tax if you've hit those particular thresholds. The obligation is on you. They don't automatically do it, so you do need to be aware of that. Looking at the foreign person or absentee surcharge, so South Australia, WA don't have these foreign person or absentee surcharges. Northern Territory doesn't have land tax in general, so don't need to worry about it. Other states have a particular threshold that's independent of the normal land tax threshold. So you can see here that, so New South Wales is the highest at 5%, and that's been ratcheted up over the last few years. So you could have a situation where someone's had a property value worth $1 million, so they're not getting land tax, but they have to pay the surcharge of 5%, which is 50 grand a year of the surcharge duty if they're a foreign person. Now, the foreign person definition is quite different in each state, as I mentioned, but the one thing to be aware of is, and the one thing that's consistent, is if you're an Australian citizen, then you will never be a foreign person. So a citizen will always be not a foreign person. But what's inconsistent is some people treat New Zealanders or people who have PR visas as also never foreign persons, whereas others say, no, you still could be a foreign person. It depends on how long you're in Australia for, and it might be 200 days, for instance. So you do need to look at those particular rules. But owning a property, or if you're looking to purchase a property and your spouse is not from Australia and doesn't have permanent residency or citizenship, ideally, then you want to look at how that may be purchased, because you might be stuck these foreigner surcharges, and they can be significant. Okay, so having a look at some ownership structures for property, there's a couple of more common structures, and then there's some that's sort of less common. So the typical ones we would see is if they're in personal names, and that can either be typically a husband or wife, spouses, either singularly or jointly. It could be in a trust, or it could be in a partnership. Less common structures things like companies. Now, there are some exceptions to that. The main reason for a company not to be an ideal structure is because the capital gains tax discount won't typically apply to a company. Sometimes that's not relevant. If you're looking to develop property, then you may then not be operating on revenue account anyway, so you wouldn't get a CGT discount anyway. And there may be other reasons why you actually want then to have some sort of legal separation there. If you had a somewhat risky investment, then that's maybe when you sort of go into the company structure. But one size does not fit everybody. You really need to understand a whole bunch of facts before you can come up with where the ideal structure is. Some things work for you and against you, and on the same property. You need to consider the life cycle of the property. For example, if the property is going to be positively or negatively geared, that's a big deal, because obviously positively geared property you may want to have in a lower earning individual, or negatively geared you might want to have in a higher earning individual. But sometimes that may change over time depending on, someone might be planning a career break, or if you're non-resident, then we may completely disregard that because you are not being taxed on your overseas income. So you do need to understand what your likely life cycle is going to be on this particular property. If you're ever going to use the property as a main residence exemption, as your main residence that you live in, either in full or in part, then there's particular structures that works in, and most structures don't. So you have to own that personally for that to apply. You want to look at the CGT discount, the tax rates of the potential owners, and the costs of each of these particular structures, because some are more complex and some take a bit more work, and then some actually have higher rates applicable to them. For example, if you had to take out a loan with a trust or a company structure, that may be at a higher rate than, say, in your personal names. You also have higher rates of stamp duty and those sorts of things, and land tax that may apply in a trust or a company, for instance. So a lot to sort of digest there, and hopefully you get the understanding that it is quite complex, and you really need to look at this personally before we come to any sort of formal conclusion. But there's some sort of rules of thumbs that you might want to have a think about. So if you're ever going to live it in as your main residence, then you want to use it in a person's name. It can be either one of the two spouses or jointly. You can't get the main residence exemption if the property's in a trust or in a company. If it's negatively geared and capital gains are kind of negligible or likely to be net negligible over time, then that's something you'd put in the name of the highest income earner, potentially, because then you get the benefits of the higher income earner over the life cycle of that. If, however, though, it's going to be positively geared, then you'd either put that in the lower income earner or a trust, which then gives you the flexibility to choose year on year. If you're expecting some reasonable capital gains to apply, then again, you want to have that in the person's name who has the lowest tax bracket. So that's either a lower income earner out of a couple relationship, or in a trust that gives you the flexibility to sort of change year on year. If there is a great variance between couples' incomes, then a trust can work quite well for you. The CGT discount can still apply to you if you are in a trust structure. So some people may buy a property in a trust whilst they're overseas to preserve capital gains tax discount. You do need to be aware that for that to be the case, you need to have a trustee that's a tax resident, which normally would be, a corporate entity that's an Australian incorporated company. ASIC does require, under the Corporations Act, that you have a resident director at all times. So that can complicate things if you've got really the owners are outside of Australia, because then you have someone who's a director of that particular company who has some sway in how the decision making goes, including the sale of that property. Then you've got to really trust that person as to what their particular role is. There's also non-tax issues to consider, so things like legal liability as well. So you need to kind of throw the whole lot into a melting pot, and hopefully that gives you some understanding of that you do need to consider these things in their particular context. So just a couple of tips for selling a property as an expat to sort of round things out. The date you sign the contract is the date the CGT event occurs. So that is quite relevant. A lot of people think, if I sign the property before I leave, or if I sign the property before I get back from overseas, but then it settles whilst I'm back in Australia, I'll be okay. No, that's not the case. But conversely, if you sign the contract and it's got a 3-month settlement clause before you depart Australia, then you could still be eligible for the main residence exemption, even if it settles whilst you're non-resident. It's really critical to understand that your potential tax liability before you sign that contract. It's really hard to undo things if you find that the tax outcome is a deal breaker to you. So, we run calculations people all the time to work out what the possible tax is going to be on that particular property. Sometimes it's not as bad as you may think, or when you maximize the cost base and you apply the discounts and any other sorts of things you can apply. So, but running the numbers at least gives you an understanding. And if that's a deal breaker, it allows you to go and cease any particular thing that you might regret. Some people, like I said, if it's a deal breaker, then they may consider alternative scenarios. So rather than selling whilst non-resident, you might actually hold it and rent longer. You might even, in some cases, leave the property vacant rather than letting it be rented out past a 6-year continuous time, because that then means you can treat it as your main residence indefinitely. And there are some circumstances, typically in those properties that are quite high in value, that when you consider all things, leaving that property vacant is actually a better tax outcome than having someone continue to rent that out, and then be liable for a fractional CGT percentage on that when they end up selling it. One thing you need to be aware of is when you sell the property, you need to be up to date with your tax returns, or the ATO will not approve a foreign resident capital gains withholding variation. So a lot of clients I'll see will come to me realizing that they've got this settlement in 30 days and they've got 15 years worth of tax returns that they haven't been up to date with. Now, we can either work really hard to get that done, or you have to sort of bear that 15% until you get everything squared away. And then that could mean the tax office holds on to your money for a year, 18 months, depending on the time in the year where that transaction occurs. The foreign resident capital gains withholding approval typically can take up to 28 days. It's the service period the ATO allows. So just bear that in mind if you're signing a contract. For some people who are signing a very quick settlement, is it may not give you enough time to get a variation over the line. And we've got some great outcomes we've got with the tax office and direct contacts that we use there, but I don't want to promise on their behalf that they're going to be able to always deliver in super speed time. They may just get an influx of a whole bunch of things, or information may not be fully complete. So, you do need to allow up to 28 days to have that processed. Another thing that a lot of people don't realize is that the periods of time where you're living in the property and you're incurring costs, for example, mortgage interest costs, council rates whilst you're living in it, they can all be added to your cost base if you are indeed taxable as a non-resident. You do want to maximize that, but a lot of people just say when they buy a property and they live in it, they just don't worry about the tax records there because they think, oh, we'll never need to use that. It's my main residence. I don't get any sort of concessions for it. It's not going to be taxed to me when I sell it. If you keep those records, then you can completely add those to the cost base. So starting that paper trail early, particularly if you're moving banks, which is where we see a lot of the problems. So you refinance a loan and then all of a sudden there's no data that's being kept after 7 years from the prior bank, then it makes it hard to reestablish a cost base. And sometimes that could be, saving hundreds of thousands of dollars on a capital gains tax calculation. Another thing I'd say is don't trigger a tax audit by completing your information incorrectly. So one thing that happens is when you do a variation and send that through to the tax office, they dig through all the information and make sure everything's lodged, that everything's up to date. They go through your residency to make sure they're comfortable with that. If things are out of place there, it's the surest way to try and show that your situation is more a greater look in. And if you've got, potentially incorrect lodgements or things like that that might have been hanging over your head, then could really jeopardize your whole sort of tax profile. So you want to make sure that you're addressing the issues correctly and making sure you're on the front foot. by getting someone like us to be able to assist you through the process. All right, so that's it from me and Jeremy, but happy to open it up to everyone for some questions now.
Lovely. Thanks, Ben. So I've got a couple of questions that have come through as you were presenting, so I might just let you regroup, grab a glass of water, but I'll read these out to you, and I'm sure you can read them on your end. But we had a question come through from Maria. What would the tax implications be if I only live 3 to 4 months in a property before going overseas, and then with a clear intent of coming back after 2 years once the contract's up? And I'm assuming Maria would move back into that property after the 2 years overseas.
Yeah, so in this particular scenario, assuming if you live in the property 3 to 4 months before going overseas, then I'd be satisfied that you've activated the main residence exemption at the starting point. So you need to move into that property for that to activate in first instance. So this wouldn't be the case if you bought the property whilst you're overseas and it doesn't activate until you move into it. But this is a perfect scenario where you've activated that. The first 3 or 4 months is considered as your main residence. You then get another 6 years, up to 6 years of that being treated as your main residence. And therefore you come back to Australia. You don't even have to move into that property, as I mentioned. In this situation, it's most likely 100% CGT exempt under the main residence exemption, assuming there is no other main residence that you buy during that particular time, etc. So that should be a positive outcome.
Okay. And question from Laurie, can an Australian citizen be subject to the absentee surcharge in ACT?
No, so like I said, all citizens will never be a foreign person. So
Yep.
it's only for people who are not citizens.
Yep. And I'll just piggyback off that. I sort of have a lot of conversations with clients who are in a spouse relationship. One's a citizen, maybe one's a permanent resident, maybe they've just got their spousal permanent residency, perhaps they're going for it in the future, or they're just complete non-res. The default position is always, if they're looking to buy a property in Australia, buy in the citizen's name only, and then we can still look at lenders, and lenders will be comfortable to have you both on the mortgage if that's your wish. Perhaps but we need both spouses or both partners' income for servicing. There's options out there. So maybe to use a complete non-residence income, we'd have to go to a second-tier lender. Someone like a Commonwealth wouldn't accept, let's say someone's a UK citizen only, no ties to Australia. If we want to use their income, there may be some issues around that, but that's going to work out much, much cheaper for the citizen and the non-citizen in the future. Because as you were saying earlier, if they're buying to Sydney, a future owner occupier, and it's in both their names, then they'd be subject to all those additional charges, not just at settlement, but whilst they're holding that property. So that's not a deal breaker, having it in one person's name only and both on the mortgage. Lenders are generally comfortable with that. They understand that structure. If we can demonstrate there's that spousal relationship and there's a benefit for both being on the mortgage, which of course we can. Okay, There's a question here from Anonymous. So I rent my main residence for 5 years whilst I'm overseas. I knock it down. I've got vacant land for 4 years. Then new home's built and his son lives in it for 11 years whilst he's overseas. If he sold it when he became a resident, is the vacant land taxed as a non-resident or resident, lived in the home for 14 months before going overseas, lived overseas for 23 years? That sounds like some specific, I don't think we want to put people to sleep just yet. So maybe we'll...
I can answer that at a high level, right?
Yeah.
So the critical thing is the starting point. You're going to need to hit a few points there. So have you moved into that property and established it as your main residence from the outset? It sounds like yes, you lived in it for 14 months. So yes, that 14 months is treated as your main residence. Then you rent it out for 5 years. So that is still treated as your main residence under the 6-year rule. So it seems like you're okay during that particular period. You bulldoze it, land left vacant. So you haven't gone past the 6 years because it hasn't been rented. Then you build a new home and your son lives in it. Now, a lot of this comes down to the commerciality of that agreement. If it's a commercial arrangement, then it is considered that it is then rented. So you do need to look at that. If it was just that it was, no rent and it was just living in that property for you, it's likely then that the main residence exemption could keep continuing in that scenario. So depending on a few little factors there, it may be a really good outcome, and you may get potentially up to all of it tax free, but you need to dot all your I's and cross your T's on these points to make sure you're absolutely comfortable. But there's a possibility there in that scenario that that is completely tax free, depending on what the arrangement was with the son while you're living in it.
Yep. Yep. Good answer. So I've got a really good question come through regarding mortgages. So husband and wife, both Australian citizens living overseas, so expat, they've got an investment property in a prime area. It's tripled in value since they purchased. Great stuff for you guys. Small mortgage, they don't live in Australia and they're trying to refinance. And well, number one, can they use the equity in that property to buy a second investment property? Yes, you can. So note here, they've noted that they've spoken to their current bank. They've said no, they don't count overseas income, and they feel a bit stuck. So this is a classic. You've just gone back to your bank. They may have been really helpful when you got that property whilst you're in Australia. So let's give some examples, because I think it's always worthwhile to kind of, ING stopped lending to expats about 4 years ago. Macquarie shut up foreign income about 2 or 3 years ago. So let's take an example. You've got a mortgage with ING or Macquarie. They're happy for you to stay on their books to pay off their loan, but if you go back for additional lending, that's a new credit assessment and they'll say, sorry, can't help you. Kudos Bank was very active in the expat space up until about 3 years ago. Again, no new lending except small top up. So you're going to hit a roadblock. So what we might need to do is refinance the existing loan, take that to a new lender that will support and accept your foreign income, pull out the equity. So if it's tripled in value, I don't think there'll be an issue around taking equity release against that property and then taking a new mortgage against property two and potentially borrow maybe 100% of that value. So as you said, if you don't want to put money down, we can use the equity instead. The biggest hurdle will just be serviceability. So running a serviceability assessment to make sure that the bank will allow that, a lender's got that current policy, and then ensuring that you've both yourself and your wife have got income to support that new lending. So yeah, yes, you can. We just need to run a serviceability assessment on that. Okay.
Sounds right in your wheelhouse there, Jeremy.
Yep.
Happy to speak to you.
I've got a few more questions that come through on the chat. So from Leon, what's the minimum period? Oops, sorry, he's just jumped down. There's a few more come through. What's the minimum period you need to move back into a property to reset that 6-year rule?
So it's a good question. It needs to be somewhere that you've moved into genuinely treat it as your home. So, and there's no definition for that. So could you honestly say that you've moved into the property and expect to treat it as your home, as opposed to it being some sort of transitory stay? That's what the tax office is looking for. Is it genuine that you're moving into it? There's a lot of things they'll look at. It could be just a couple of months, but it really could depend on broader circumstances. It could be you've come back, you've finished an assignment overseas, you're moving back to Australia, you've moved back in, you've shipped all your belongings there, you've updated the electoral roll, you've got utilities all hooked up. 2 months later, you get tapped on the shoulder by a recruiter and they offer you a job that you can't refuse. You're on your way again back overseas. It wasn't intended at the time. I have no problems that the tax office would accept that that had become your main residence again. Say a different scenario though, that you've gone back, 6 years is coming up, you still keep your job overseas, you come back to Australia, you spend 3 months in the property, you still kept your foreign property on foot whilst, because you didn't want to break the lease. You haven't given anything up overseas, and then you just jet back overseas again. The tax office will look at that in broad context and say you haven't really genuinely tried to make that your home. You've just come back and occupied it for a short period of time. It's not intended to be your home as such. So you do need to look at the whole context. There's no exact time period. You need to look at whether or not it's genuine or not.
Yep. And a similar question from Claire. So how long do you need to spend in Australia, or what do you need to do to re-establish your Australian tax residency? Example, I want to purchase a property in New South Wales and then return overseas. How long will I need to spend back in Australia to re-establish residency or live in the property for the main resident exemption to apply?
So, look, becoming a resident is dependent upon all facts. You're going to need to satisfy one of the residency tests to be a tax resident. So, um, typically the resides and domicile tests are most applicable, but it does depend on your personal factors. So, the domicile test applies effectively to citizens or those that have a domicile of choice. So, it could be if you've got a PR in Australia. It's harder if you're a foreign citizen in a never established PR for you to become resident than a citizen. Mainly that just requires you to give up a permanent home outside of Australia. So, it depends on a few factors, but you'd want to be giving up your foreign home if you kept that rented, if you kept that lease on foot whilst you're overseas, then that could be a problem for you. But as a rule of thumb, you'd want to spend, I would suggest, at least sort of 6 months in Australia to be sort of comfortable that you're probably hitting residency. Um, but you want to be careful that the HA doesn't sort of see that as a scheme with the sole purpose of avoiding tax, because there is an anti-avoidance provision in the tax rules that looks at if you've done a scheme that's sole or dominant purpose is to just avoid tax, then um, they can disregard that whole transaction or the facts that you've put in place and tax you as if that didn't apply. So you want to be a little bit careful with that. Every situation is a bit different, but I would say sort of as a rule of thumb, you probably want at least sort of 6 months to be comfortable there.
Yeah, okay. And we've got a question from Alina. So, as a citizen who hasn't lived in Australia for 30 years, what are the implications of purchasing a property versus a resident? So, I guess she's buying it if someone lived here, full cash is available. I'll just touch on, and you can jump in, Ben, just on the lending side. Some people get quite concerned that if they haven't lived in Australia for a period of time, they don't have a credit report and that lending is going to be really difficult. It's not necessarily the case. Most people will have some sort of credit file. The bank will run that when we go to apply for that mortgage. And if even if maybe it's not on file, we can always explain that around providing history of where you've lived previously. So that's, from a lending point of view, that's not going to be a showstopper on that end.
Hmm. Look, the thing I'd say about that is, you don't get any benefits of the main residence exemption until you move into that property. So, I would be cautious about buying a property prior to coming back to Australia and living in it, or at least renting it out for a number of years, because then you're always going to have this fraction of time that it's not treated as your main residence. So even if you owned a property for 10 years total, if the first 2 years you had that as rented out and not lived in by you, then 2/10 of that are going to be taxable to you, regardless of the size of the gain in the future. So you probably want to work through all of that and consider what other options might be available to you. But certain people, love the bricks and mortar and get the appeal of that. So, you consider all particular circumstances, and we can kind of talk through on a specific basis with you if you've got particular questions you want to work through on a particular transaction or home or scenario you want to work through there.
Yep, great. And then a question from Jason. So, hi guys, if I'm a non-resident
Non-resident.
and I have an investment property in Australia, can I have it vacant and deem it as my PR to trigger the CGT exemption?
Not unless you've moved into it. So the facts would need to support that.
Yep. Okay. And we've got Lena's just clarified she doesn't need a loan. Okay. Yep. So just refer back to what Ben said. And we've got a question around main resident exemption from anonymous. What if I lived in the property but also had someone else living in the property with me paying rent? Does that affect the ruling?
So it comes down to the sort of 6 year. Well, there's the concurrent ownership rules there, which is really where this sort of market valuation does come into it. So There's some, you want to work through the complexity of that. It doesn't affect the main residence exemption in many respects if you're still living in that particular property. Um, it would only become an issue, for example, if your first that period of time was more than 6 years continuous. If it was less than that and you had periods that they wasn't renting it out for that period of time, then um, it would just reset. So I'm assuming most people may not have a 6 year period of cohabitation, but I could be wrong. But it'd be good to look into that in the specifics of what you're dealing with, if that was applicable to you.
Yep. Okay. Great. And I just finally, there was a question that was coming through whilst you were doing your presentation, just around understanding how the different tax and incomes assessed on the lending side. So there was an example I just gave for one of the people listening, just around, say, if you're saying in the UAE and we're dealing with the credit policy of Commonwealth Bank, what they'll do is they'll convert your dirhams into Australian dollars, shade it by 20%, and then apply Australian tax against that income. So they'll treat you like a tax resident for loan purposes only, versus going to a lender that will look at your net of tax position. So if you think about that, just working with different banks and comparing credit policies will result in completely different borrowing capacity, what you can access. So that's just something, people just need to be mindful of. Again, it goes back to that, you may have got a no from one bank. That doesn't necessarily mean that's the end of the road for lending. There's definitely plenty of options out there. All right, that I believe that's all the questions have come from. So just to wrap this up, if you haven't followed us on socials, we are quite active there. We've got a lot of content going through the channel, so please make sure you follow, like, and subscribe. And if you're not, jump onto our website, atlaswealth.com, and subscribe to our newsletter as well. That's where you'll keep up to date with these type of events and our newsletter that we distribute.
Fantastic.
Fantastic. So just to wrap that up, thank you everyone for your time. We'll distribute these slides out via email, but if you've got any questions, please reach out to Ben, myself, or the team, and we'll try and come back to you.
Thanks for all your attendance. Much appreciated.
Thanks, guys. Have a great day.